The sure money is in front of us. The sure money has to do with the fact that world energy demand is going to double in 25 years. 25 years, world energy demand is going to double. We're going to need all kinds of energy. We're particularly going to need base load power, that's uranium, and we're going to want non-carbon generating power, that's uranium. We're in a structural deficit around uranium today, and we are not shutting down plants that had been scheduled to shut down, which means the deficit gets worse. Meanwhile, we're building new plants like mad. I asked the broker to be aggressive. We were in a period 5 weeks ago where there were no asks, there were all bids. And I've learned in the market to do what's easy. If there's no bids, be a bid. If there's no asks, be an ask. And the sector was white hot. There were so many junior financings, and when a company's financing, they're telling you that your cash is worth more than their stock. Well, they should know what their stock is worth. Since they were selling, I decided I would sell some too. But what was most important to me was personal. I've been a heavy investor in the sector since 2020, and I was at a period of time where I could, by selling a quarter of my position, recoup all of my capital and pay the capital gains tax and have the rest for free. I can be very patient, Charlotte, with that remaining 75% because it stands me zero after tax. It was a personalized decision.
After years of building exposure in gold-related assets, some investors now see an opportunity to restructure with zero stress. By selling just a portion of their winnings, they reclaim their entire initial investment and taxes, leaving the rest as house money. That remaining position can be held comfortably for the long term, without emotional pressure tied to timing. The belief remains that gold will thrive in the next decade as monetary systems adjust to rising debt and geopolitical instability. Instead of chasing speculative moonshots, reallocating toward high-quality gold producers provides stable leverage to the metal with less risk.
I believe gold will do well in the next 10 years. And I think the market will go to alpha, which is to say, I think the market will get more speculative. For my own portfolio purposes, I think I wanted to own de-risked beta as opposed to alpha. So I bought gold, Franco-Nevada, Wheaton Precious, and Agnico Eagle. I brought the highest quality companies I could, deliberately going against the market trend, because that's who I am, but also personalizing it. I bought oil because oil's hated. And as you and I have discussed in many of your interviews, the easiest speculative money in the world is buying hate. Buy what the market despises. When that market moves from hated to tolerated, that's the easiest money that you'll ever make as a speculator. And the oil business is roundly hated right now, and it's a great business.
While gold shines in headlines, oil sits at the center of global disdain. Environmental politics, underinvestment, and demand uncertainty have cast petroleum companies into the shadows. Yet energy consumption continues to rise, and future supply isn't guaranteed. Some of the strongest global oil companies now trade at steep discounts to their underlying assets, while still paying attractive dividends. History shows the most powerful gains emerge when sentiment climbs from unloved to simply acceptable. It's hard emotionally, but financially rewarding. The hypothesis is clear. Low investment today means higher prices tomorrow, and the most resilient producers will benefit first.
This is another one. If people have been following, they will know that you've been talking about the oil equities for quite some time. So that should also not be surprising that that's what you decided to do with some of your money. I wondered if you could speak a little bit more specifically about any of the names that you like right now.
Sure. The place you start is Exxon. It's the finest oil company in the world. I believe it's selling at 60% of net present value, meaning it's selling at a 40% discount to what it's worth, while paying a 4% dividend. So there's no time value of money problem owning it because you get paid a dividend. I believe that worldwide, the energy industry, the oil industry specifically, is underinvesting in sustaining capital by about $2 billion a day, which means that the production levels that we enjoy today are not going to last, which means the oil price, at least the nominal oil price, goes up. I believe specifically that what Exxon is worth, not what it's selling for, what it's worth will double in the 3-year time frame. So I'm buying a double at a 60% discount or 40% discount to net present value for the finest company in the world. Taking a little more risk, I own Chevron because they're a more efficient refiner and marketer. I own a little bit of Occidental because of proved undeveloped locations, but they got a lousy balance sheet, but I still own it. In the U.S. natural gas business, I own Devon and I own Equitable. But where I'm really adding positions is in Canada. I understand the political risks, which are huge. But as cheap as the U.S. industry is, the Canadian industry is selling at a discount to the U.S. industry. And there's very high-quality management teams there and many more proved undeveloped locations. In other words, there's a better growth runway in Canada. Names there, I think you have to own Canadian Natural. You cover the waterfront. I own Suncor because I have no reserve risk in my lifetime. I have no reserve risk in your lifetime at Suncor. I own Freehold Royalty. I own Prairie Sky. I own ARC, which I consider to be the best run oil company in North America. I own Tourmaline. What else do I own? I own Peyto. I own Birchcliff. And that's it. I could go down the quality trail and make more money, but I don't need to. This is a portfolio that I would be surprised if it didn't double or triple in a reasonable time frame. I get paid a ridiculous dividend on that basket of stocks, and they're hated. All I need, we've talked about this for years, Charlotte, all I need to do is buy hate and let that sector move from hated to tolerated. That's the easiest money a speculator could make, financially. Not psychologically, but financially.
Major U.S. energy giants offer scale and stability, but the deepest value might currently sit further north. Canadian oil and gas companies remain significantly cheaper than U.S. peers, despite world-class reserves and long-term production visibility. Political challenges are real, but so is opportunity. Firms with decades of proved resources and robust management teams may deliver substantial growth once demand tightens. Collectively, strong dividends and undervaluation create a setup where patient investors can reasonably expect portfolios to multiply in the coming years. This strategy isn't about chasing risky juniors, it's about owning durable assets waiting for recognition.
It's interesting that people think that their time preferences matter, because they don't. The oil market doesn't care about your time preference, nor did the gold market. It's only you that cares about your time preference. Everybody wants a short-term sure trade, and those don't exist. So it's like wanting the tooth fairy. What I've learned in 50 years in the business is that a suitable time frame for being right is 5 years. I wish a suitable time was 1 year, but I haven't known any successful one-year investors. I'm perfectly cognizant of the fact that the oil price might go lower and oil stocks might go lower. I've done that a lot of times in my career. What I've learned is that sometimes stuff is cheap enough. When it's cheap enough, you buy it. If you're wrong by a year, that's okay. I don't know if you remember this interview, but years ago, I said that the success in my life was that I preferred to ask myself questions where the answer began with when, not if. Too many people ask themselves questions where the answer begins with if, which is a very risky question. For me, if I'm a year and a half early, but I get a triple or quadruple, that triple or quadruple pays a lot of rent. I have to be right. The arithmetic around oil means I have to be right. I just don't know when, and I don't care.
Yeah, I think people do focus so much on getting it exactly right, and that's not really what you have to do. While we're on the topic of energy, I wanted to bring up uranium because I don't think we've talked about it for a little while, and I wanted to get your sense of where we are in the uranium cycle right now, if you could help me situate us.
Charlotte, you and I have been so right on uranium for 5 or 6 years that the prudent thing for both of us to do would be to shut up and rest on our laurels. But people by now care what we have to say. The easy money in uranium has been made. The easy money was when you and I were talking about it at $20, saying it had to go to 60 or 70. It did. So those stocks are up 400%, 500%, okay. The sure money is in front of us. The sure money has to do with the fact that world energy demand is going to double in 25 years. 25 years, world energy demand is going to double. We're going to need all kinds of energy. We're particularly going to need base load power, that's uranium, and we're going to want non-carbon generating power. That's uranium. We're in a structural deficit around uranium today, and we are not shutting down plants that had been scheduled to shut down, which means the deficit gets worse. Meanwhile, we're building new plants like mad. Most importantly, and this is maybe subtle for some listeners, the structure of the uranium market is going away from reference to spot and going to term. And that means that unlike any other commodity in the world, uranium producers are going to be able to lock in production volumes where they understand how much they're going to be able to sell and at what price. There will be a revenue certainty in uranium that doesn't exist in any other commodity in the world, which will lower the cost of capital. There's no other commodity in the world that has that market structure.
Investors often obsess over perfect timing, but the market doesn't care about our schedules. Short-term forecasts are unreliable, yet fundamentals always win eventually. Energy demand grows, supply declines, and arithmetic forces a price response. Being early can feel wrong, but waiting for certainty destroys opportunity. The question shouldn't be if value will be realized, only when. Long-term success often requires enduring downturns with conviction. As long as the investment case is strong and the price is cheap enough, patience becomes a competitive advantage. Compounding rewards those who allow time, not emotion, to guide decisions.
So if you want to make money in uranium today, if you didn't listen previously, but you're hearing that the shore money is still on the table, what's the best way for somebody to do that?
Just buy Cameco. And understand that Cameco may fall 35%. It may fall 35%, but it's the bellwether for uranium, and uranium is a 15-year no-bagger. But I mean, no-brainer. It might not be a no-brainer in 12 months, but 12 months doesn't matter. I mean, it might matter to your listener, but that's because your listener's out of touch with reality.
Well, and speaking about Cameco, any thoughts on the recent deal between Cameco, U.S. government, Brookfield for the nuclear reactors?
What I like about it is it's indicative of the return to public favor for uranium. 6 years ago in the Biden administration, uranium speculators like me were vilified. They hated us. Now these morons want to subsidize us. Now, I would caution your listeners to know that this is a political promise. Politicians lie when their lips are moving. So this might happen, this might not happen. But the truth is that Westinghouse's technology will become the premier processing technology in the world. Westinghouse will win, which is Brookfield and Cameco. Brookfield has wonderful demonstrated expertise worldwide in project finance, and Cameco is the technology leader in uranium. Whether or not this initiative wins, that combination will win. Don't hold your hat on $80 billion coming from the U.S. government. It might happen, it might not happen. What will happen is that uranium will be an increasingly important part of the energy scene over the next 15 or 20 years, and Westinghouse will win the technology race.
Nuclear energy is experiencing a global reassessment. Nations aiming for carbon reduction increasingly recognize uranium as the only scalable baseload option. Reactors once slated for shutdown are receiving extensions, and new facilities are being fast-tracked worldwide. The uranium market has already delivered strong gains, but the structural shortage ahead suggests the cycle is far from over. A unique shift is underway. Long-term supply contracts are returning, giving producers financial certainty rare in commodities. This stability could accelerate mine development and attract major capital. As governments rediscover the value of nuclear power, leading uranium companies are positioned to dominate the next energy era.